Today, folks, unfortunately, Bell is getting absolutely wrecked. The stock is now down almost 50%, around 45% from the last 5-year high, which was just in 2022. The dividend yield is approaching damn near 10%, and we just had that major drop happen today. I mean, the stock is down a whopping 10%. We're going to break down what's causing this significant drop specifically today, where the stock's going in the future based on my opinions, my assumptions, because these are more or less interest rate sensitive stocks. We're also on the back of new economic changes in Canada when it comes to immigration that really help boost this company's performance, because everyone coming to Canada, all the immigration, they obviously wanted to get internet. I mean, it's like a necessity at this point, right? So let's kind of break this down by bits and pieces, because I mean, it is looking incredibly juicy when one of the Canadian mega caps drops this significantly. I mean, we're talking about stepping back 10-15 years in time in value. And if we take a look at basically the dividend yield, I mean, it's never ever been this high in its entire history, with the exception of some like weird happenstance. It doesn't make sense. I mean, that's some technicality probably based off earnings or whatever. But I mean, you take a look at this, right? And again, guys, is it really worth taking a stab at this, getting like a full rate of return just from the yield? Now, I do want to point out some of the recent news, because they haven't cut the dividend, but they are stopping the increases, right? I mean, this was a company that over the last decade went from about 62 cents a share to $1. So we had 10 years of getting to a point of doubling. And again, now we're stalling out, which actually kind of looks comparable to maybe something like the earlier 2000s where the dividend didn't do too much. But when you got to recognize the absolutely absurd starting yield, it gets harder and harder to increase it on the back of a company that is struggling, right? Like, because typically higher dividend yields are usually a sign of a struggling business. So is the business struggling today? Absolutely. There are some concerns. We're going to get to those concerns, but what's the news that drove that 5% drop? Well, BCE is to acquire Ziply Fiber, which is accelerating its fiber growth strategy across North America. And I just want to break down parts of this deal, because it's a $5 billion deal, which is just insane, and is expanding their footprint in the United States in fiber optics, which honestly I think is a good thing for the business. I like that they're making these kind of investments, and they're doing it off the back of sales of other aspects of their business, which we'll get into. But Canada's largest communication company announced today, and I wonder if it's still the largest at its current market cap. We should do some comparables, but announced today that its wholly owned subsidiary Bell has entered into a definitive agreement to acquire Ziply Fiber, the leading fiber internet provider in the Pacific Northwest of the United States, for approximately $5 billion in cash, and the assumption of outstanding net debt of approximately $2 billion to be rolled over at transaction close, representing a transaction value of approximately $7 billion. This transaction enhances Bell's growth profile and strategic position by giving it a foothold in the large, unpenetrated U.S. fiber market, while increasing its scale, diversifying its operating footprint, and unlocking significant value and opportunity. Basically, the footprint from 2020 with over 1.3 million fiber locations across the United States, and plans to reach more than 3 million locations in the next 4 years. So this really looks like the next big growth phase to some extent. For Bell. If we scroll down here, they paid about 14.3 times 2025 estimated adjusted EBITDA, which, you know, is probably a fair value, maybe even a little bit of a premium in this current market environment. But, you know, we're not talking about buying like a 30x value tech company here. So, you know, it's not the worst thing, especially with the scaled growth that they're anticipating, expanding the business. So basically the acquisition and financing, basically, as far as we can tell, which is expected to be funded from the net proceeds of the divested MLSE. This isn't really coming out of shareholders' pockets as much, which is good to hear. We're not talking about dilution. A lot of good measures here in this acquisition, in my opinion. The dividend, what everyone wants to know about. Basically, the current level of $3.99 per share during the financial year of December 31st, 2025, in context of the strategic acquisition, is to focus on long-term value creation for shareholders, and BCE intends to pause the dividend growth until BCE's dividend payout and net debt leverage ratios are tracking towards out target policy ranges, subject to review annually by the BCE board of directors, which I'm sure we'll get more clarity on when they post the earnings next week. We'll talk a little about the last earnings, so I'm very excited to see what the next earnings are, because we're starting to see a recovery in net income. As mentioned, these companies have been going through these cyclical cycles. We've seen it in the United States. It doesn't seem to be like Canada specific, even with the immigration growth that we had. But revenues have slowed down pretty significantly on the back of a lot of competition, price competitiveness that we've seen against the few monopolistic, duopolies, or whatever you want to call them, the few handful of, telecom giants we have here in Canada. So revenue hasn't really been declining majorly, but obviously net income has taken a drastic hit. And this is caused obviously by the interest rate cycle that hopefully we're going to start to get some clarity on, the debt facilities as they see interest rates come down and what the interest effect has on those books. But something tells me we've probably seen a bottom now in, the drop in net earnings, which again, there's a direct correlation here. Like most stocks, for the most part, outside of hype stocks, tend to follow earnings. And if you just take a look, I mean, every quarterly report up till recently, the stock has been going down on those earnings, which has just been terrible, unfortunately. And honestly, the company's not doing anything too bad here. I mean, we're not talking about, again, there's no dilution going on, which is great to see. It'd be great to see if the company was able to buy shares, but I'm happy with them investing into growth opportunities, especially diversifying outside of Canada, giving themselves some future growth metrics. So let's just dive a little bit deeper into the earnings themselves. There's not much else to touch on, I think, other than the fact that people will kind of say they can't afford the dividend. I honestly think the dividend is still affordable from as much as I can tell, because obviously if we take a look, we don't get enough factors in here. These infrastructure companies have a lot of debt. They have a lot of depreciation and amortization costs that you will not see show up in free cash flow numbers or net earnings, because obviously if they're paying out like almost $1 a quarter, they can't really afford it with an earnings per share of 59 cents. But again, if you dig a little deeper, as I've always mentioned, right, depreciation and amortization are well over $1 billion in value for the last quarter. This is capital that just gets written down against the earnings per share. You don't see it show up in EPS, but it's still part of free cash flow. And then you also just take a look at like impairment of assets that get written down. You've also got these interest expenses, and this is what I'm paying most attention to because they're probably, I wouldn't be surprised, close to $500 million. I mean, again, this is quarterly, right? 426 million a quarter. An insane interest expense, which is still up from last year pretty significantly too, by almost 60-70 million bucks. I mean, that's a pretty significant increase. So I think we're going to be in a place where, as long as the interest rate cuts continue to be aggressive, which they will be more than likely in the back of this teetering edge of a recession here in Canada. So if we really start to see the interest expense start to come down significantly on the back of interest rate cuts, in the coming 3, 6, 12 months, this is again going to start to bolster the stock and continue to hopefully justify the absolutely absurd dividend yield that we have today. And I mean, they got the back of a few businesses that I'm not a big fan of either. We've talked about, I do not like media as a business. Outside of YouTube, I think everything else is scary as hell and it's very cyclical. YouTube has such a dominating sense of not having to pay for content. It's also like, it's just a beautiful system, right? Whereas, Crave, which is what, if you know Crave, which I don't really know, we don't use Crave, but it's growing. It's growing at 23%. Their digital revenues, right, from subscriptions are up 21% year over year. So Crave continues to do well. Obviously, CTV is doing well, even though they just liquidated a huge percentage of their media business, divested out of that. And again, I don't think that's a bad thing per se, but it just shows you the volatility and the cyclicality of the media business. So I'm not a big fan of it, but they are very diversified. So I wouldn't worry too much about it overall. Wireless is still growing nicely. I think the business has, again, some good potential. We just don't have the onslaught of an insane immigration period. Like we're just cutting off so much immigration that I don't think net new sales in Canada are going to be as high as they have historically been in the past, which is something TELUS did exceptionally well on, seeing like record signups. And obviously, TELUS, as mentioned, trading at $32.4 billion, could very likely surpass Bell here very, very soon, depending on what these earnings say for the company. So again, it'll be really neat to see. I like Bell. I've always liked the Canadian telecom giants, but again, I wouldn't buy them purely as something that I would say, hey, I expect like outsized returns here. I always just believe investing cost averaging into index funds. But again, if you are a yield-oriented income investor, I think you should take a double take on this. Maybe do some projections, look at potential return to cash, hundreds of millions when they stop putting it toward interest expense, this future potential in the United States. Again, I don't think the company's doing anything wrong. If they can sustain this dividend yield, I think this is a buying opportunity for sure. But again, time will truly tell, and I'll probably update the earnings here once they come out next week or later in this week, I believe. Actually, I think it is the latter half of this week, but you'll have to subscribe to find out, and I'd love to know what you think in that comment section below.